One last thing before we go is I kind of want to do a deep dive in one area.
Yeah, let's
And
do it.
by deep dive, I don't mean we have to go on and on, but let's talk about for the listeners, tax loss harvesting and the not so commonly mentioned tax gain harvesting.
Yes.
Um, and and maybe the great tools, but also maybe not as powerful as people may think due to things like capital loss carryover, and some other things in there. They sound great. I'm a believer there's a time and place, but not necessarily a ace in the hole for the final piece of the puzzle, right?
Yeah. So let's, first of all, when we're talking about tax gain harvesting or tax loss harvesting, we're only talking about our taxable brokerage accounts.
Right.
No Roth IRAs, no HSA, no 401k, no traditional IRA, none of that stuff. Literally our holding in our our taxable accounts. Okay. Tax loss harvesting. So this is okay. I review my accounts and I say, oh, look, there's a loss in that account and in that particular holding.
Mhm.
So what I could do is I could sell that and trigger the loss on my tax return. And then what I can do is either I can rebuy the same investment as long as it's been over 30 days, there's a 61-day window, 30 days before the transaction, 30 days after the transaction where I can't rebuy, or to the extent I rebuy, the loss is disallowed and suspended really.
Mhm.
Okay. So that's a potential path where I could either sell that and then rebuy it later. It's got to be, at least a month later, generally speaking. Or I reallocate because maybe I just didn't like that holding to begin with. So I pop the loss and I reallocate and improve my investment position. Now, some people these days try to structure their portfolio so that they'll automatically qualify. Sometimes this is referred to as direct indexing. So instead of buying ABC large index fund, they buy individual shares of most of the index. So they've got, Acme Company and Beta Company and Charlie Company, all these different individual equities. Well, even in a high stock market year, a year where the stock market's going up, odds are 10%, 20%, 30% of individual equities in an index are going to go down. Their sector's down. They got bad management. A competitor, was better than them, whatever it is. So what they do is they hope and pray. Hopefully 10% of these equities go down in value. So then I can sell those and trigger the loss. But Jason, you referenced maybe that's not going to be the best planning. Why? Because of the limit that on capital loss utilization.
Mhm.
So when you have capital losses, you can use them to offset your other capital gains.
Mhm.
That's great. You might not have that much in capital gains, especially if you're an accumulator. You might just
Mhm.
not be selling stocks at gains. Everything stays invested because you have no reason to sell other than to trigger losses. Um, it can offset capital gains, and then it can offset up to $3,000 of ordinary income. So that's your W-2, your Roth conversion, your IRA distribution. That could be helpful. But I say, well, wait a minute. Who's the person who got to an early retirement or financial independence or whatever your financial goal is because they popped a $3,000 loss against ordinary income on their tax return every year? Like, I just don't
Right.
know that person. And yes, the unused losses carry forward indefinitely to the succeeding years. Like, I get that.
Mhm.
But I think it's of limited value. Look, in the right profile, it could be highly valuable, but and to the extent it's highly valuable, it's probably only going to be highly valuable for 1 year. But that's
Mhm.
tax loss harvesting. And it's a sort of thing. Look, if your portfolio's got a loss, you should at least be thinking about it. Okay. So that's tax loss harvesting. Tax gain harvesting tends to be a retirement play. So this takes advantage of the 0% long-term capital gains bracket, which, by the way, we've had since the year 2008. And by the way, I was listening to another personal finance podcast recently. They had a guest from New Zealand. New
Mhm.
Zealand doesn't tax capital gains,
Hmm.
right? There are other countries that don't even tax. There's arguments around that. I don't want to get into that today. But our 0% long-term capital gains bracket isn't as extraordinary as you might think it is.
Hmm.
But okay, let's think about that long-term capital gains 0% bracket, very valuable depending on the profile. And you could do two things with this. So you could say, oh, you know what I want to do? I've got, an old stock position or even a mutual fund position, and I can either reset the basis and then just rebuy. And by the way, there's the rule on the tax loss harvesting is called the wash sale rule. It's 30 days on each side of the transaction, 61 days total because you got the day of the transaction. Tax gain harvesting, that doesn't exist. You can sell it on the first day, and as long as you're not buying it back from your brother or your mom, you're just fine, right? You go back on a brokerage, they connect you with a third party, you can rebuy that. And they call that a basis reset. And so what that's doing is it's saying, well, I had this capital gain, let me trigger it while I'm in the 0% long-term capital gains bracket and then reset my basis. And then later on, when I might not be in the 0% long-term capital gains bracket, I sell it at that point to fund living expenses, say, well, now because I got all this basis, I don't pay tax on it then either. Right. So that could be a great thing. Or it could be essentially a reallocation. So you say, oh, I worked for this tech company. Its stock went to the moon. I have this old employer stock. And what I want to do is I want to sell it and have that loss hit the zero, or have that gain hit the 0% long-term capital gains bracket. So I'm not paying federal income tax on that. And then what I'm going to do is take those proceeds and buy a diversified holding. And that diversified holding will now have the step up in basis, and I've improved from an investment perspective. So that's another play on the tax gain harvesting. I think they're both things that it's helpful to know about. But I will say they're both of a little bit limited value. And then sometimes I get this question, should I do a Roth conversion or tax gain harvesting? That's a question that seems to come up. And look, I tend to bias towards, if you're going to do one or the other, but not both, then I would generally be biased towards the Roth conversion. I say that because with the 0% long-term capital gains bracket, the original owner may never pay cap gain on that anyway, because they might, when they need it for their living expenses, might be in the 0% bracket. Right. And that person might just die holding it, and then it gets a step up in basis at death. Traditional IRAs never get the step up in basis at death. Right. Now, I will say this, though. If you're in a traditional IRA that's got a nice diversified holding and your taxable account is all in one tech stock, I'd probably favor tax gain harvesting over the Roth conversion for investment reasons. And I think those investment reasons are more compelling than the tax reason. The idea being, hey, let's use the tax gain harvesting angle to efficiently reallocate into a more diversified holding. And yeah, the traditional IRA's got its drawbacks, but at least it's in a diversified holding, and we'll figure out some tax planning for that later on.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.